You know what makes my blood boil? It's watching hardworking Americans who've paid into the system their entire lives get blindsided by Medicare costs they never saw coming. And here's the kicker. Most of you are overpaying by thousands of dollars every single year because nobody's telling you about something called the Medicare Premium Payment Plan, or MPPP for short. Now, I'm going to be straight with you. The government isn't exactly rushing to advertise this option, and that's by design. See, when you turn 65 and enroll in Medicare Part B, the Social Security Administration gives you two choices. Pay your premiums upfront every month or let them deducted automatically from your Social Security check. Sounds simple enough, right? Wrong. Because what they don't tell you, and this is the $2,100 question, is that the MPPP allows you to structure these payments in a way that actually keeps more money in your pocket throughout the year. Here's how most folks are getting this wrong. They're letting Medicare take that premium right off the top of their Social Security deposit every single month without understanding the cash flow implications. And let me tell you exactly what that looks like in real dollars and cents, because this isn't some theoretical discussion we're having here. This is your retirement money we're talking about. This is the money you worked 40, 50 years to accumulate. Every single dollar matters when you're on a fixed income. And I'm not about to let you throw away $2,100 because the system is designed to be confusing. So here's what's happening in millions of households across America right now. Mary retires at 65, she signs up for Medicare Part B like she's supposed to, and the standard premium, which as of 2024 is sitting at about $174 or $70 a month, gets automatically deducted from her Social Security check. She thinks she's doing everything right. She's following the instructions. She's being responsible, but Mary doesn't realize that by allowing that automatic deduction, she's actually losing access to capital that could be working for her in other ways throughout the year. See, the MPPP isn't about avoiding the premium. You're going to pay it either way, folks. The government's going to get their money, but it's about timing. It's about cash flow management, and it's about understanding how money works, even in retirement. Now, you might be sitting there thinking, Frank, what's the big deal? Whether they take it out automatically or I pay it myself, I'm still paying the same amount. And on the surface, you'd be right to think that way, but you'd be missing the entire financial strategy that separates people who thrive in retirement from people who just survive. Let me break this down for you the way I'd explain it to my own parents, because this is that important. When Medicare takes that premium directly from your Social Security check every month, you never see that money. It's gone before it hits your bank account. You can't use it, you can't invest it, you can't leverage it for anything else. But when you opt for the Medicare Premium Payment Plan, you're essentially telling Medicare, I'm going to handle this payment on my own terms. Now, the government still offers you the ability to pay quarterly instead of monthly. And in some cases, you can structure it so that you're keeping that cash in your own accounts for longer periods of time. And here's where the math gets really interesting. Because when you've got 2-3 months of premium payments sitting in even a basic high-yield savings account earning 4 or 5% interest, you're now making money on money that would have otherwise been yanked out of your check immediately. But it goes deeper than just interest earnings. And this is what financial advisors don't want you to understand, because it puts the power back in your hands. When you control the payment timing, you control your monthly cash flow. Let me give you a real-world scenario. Tom is 67 years old. He's getting $2,400 a month from Social Security, and Medicare is taking out that $174.70 automatically. His monthly budget is tight. He's got his mortgage payment, his utilities, his prescriptions, his groceries. Some months he's scraping by with maybe $50 or $100 left over. Now, what happens when his water heater goes out? What happens when he needs new tires? He's got no cushion, no breathing room, because that $174.70 has been taken before he could even plan around it. Now, let's look at Tom's neighbor, Richard, who's in the exact same financial situation, but who opted for the MPPP. Richard keeps that $174 or $70 in his checking account every month. He's not avoiding the payment. He's being strategic about it. When his quarterly payment comes due, he's got the full amount ready to go because he's been managing it intentionally. But here's the difference. During those 3 months, Richard had access to an extra $524 down. That gave him flexibility. When his grandson's birthday came up, he didn't have to stress about buying a gift. When his medication copay was higher than expected one month, he had the buffer to handle it. Richard is living with margin while Tom is living on the edge. And the only difference between them is understanding how to use the MPPP to their advantage. Now, I can already hear some of you saying, "But Frank, I don't trust myself to make those payments. What if I forget? What if I spend that money and don't have it when the bill comes?" And listen, I respect that self-awareness. Not everyone should manage their own payment schedule. And if you know you're the type of person who's going to see that money in the account and blow it on stuff you don't need, then maybe automatic deduction is the right choice for you. But here's what I've learned. After decades of teaching people about money, when you treat yourself like an adult and you take responsibility for your own finances, you start making better decisions across the board. You start paying attention. You start budgeting. You start planning ahead instead of just reacting to whatever happens. And here's another thing that nobody's talking about: the MMA situation. You know what IRA is? It stands for Income-Related Monthly Adjustment Amount. And it's basically the government's way of saying, hey, if you made too much money 2 years ago, we're going to charge you more for Medicare now. And this is where it gets really frustrating because your income from 2 years ago might have nothing to do with your income today. Maybe you sold some property. Maybe you took a big withdrawal from your retirement account for a specific reason. Maybe you had a one-time bonus or inheritance, but now you're stuck paying higher Medicare premiums because of income that isn't even reflecting your current reality. When you're using the MPPP, you've got more ability to appeal those IRMA charges and to manage the financial impact while you're going through that appeals process. You can request a redetermination if you've had a life-changing event: retirement, divorce, loss of income, death of a spouse, and the MPPP gives you the flexibility to handle your cash flow while Social Security reviews your case. If you're just letting them automatically deduct whatever they want from your check, you're at their mercy. And let me tell you, mercy isn't something government bureaucracy is known for. Here's another angle that's going to save you real money. And this is where that one-out $100 figure starts to make complete sense. When you manage your Medicare premiums through the MPPP, you're in a better position to coordinate all your healthcare costs strategically. Think about it. You've got Part B premiums. You've probably got a Part D prescription drug plan. Maybe you've got a Medigap policy or a Medicare Advantage plan. All these bills are coming at you from different directions at different times of the month. When you take control of the Part B premium timing through MPPP, you can align your payment schedule in a way that makes sense for your overall budget. You can make sure you're not getting hit with 3 major healthcare bills in the same week. You can spread things out. You can plan around your Social Security deposit date and any other income sources you've got coming in. And let's talk about the tax implications for a minute, because this is something that catches people completely off guard. When Medicare premiums are automatically deducted from your Social Security check, that doesn't change the taxable amount of your Social Security income. You're still getting taxed on the full amount, even though you never actually received that portion that went to Medicare. Now, whether you pay it automatically or through MPPP, the tax treatment is the same. But here's the distinction. When you're managing it yourself through MPPP, you're more aware of these numbers. You're looking at your actual income, your actual expenses, and you're in a better position to do strategic tax planning with your accountant or financial advisor. You might realize that by adjusting your withholdings or by timing certain distributions from your retirement accounts differently, you can optimize your overall tax situation in ways you never would have noticed if everything was just happening automatically behind the scenes. Let me tell you about a couple I worked with a few years back. I'm going to call them Jim and Susan. They'd been retired for about 3 years, both on Medicare, both having their premiums deducted automatically. They came to me frustrated because they felt like they were doing everything right, but somehow always seemed to be running short on cash at the end of the month. When I looked at their complete financial picture, I realized they were having nearly $350 a month yanked out for their combined Medicare Part B premiums before they ever saw their Social Security money. I asked them a simple question: what if you had an extra $350 in your checking account every month? How would that change things? Susan's eyes got big, and she said, "Frank, that would be a game changer. We could actually breathe." So we switched them to the MPPP structure, set up a separate savings account specifically for their Medicare payments, and had them automatically transfer their premium amount into that account each month. But here's the beautiful part. That account was earning interest. Not a ton, but over the course of a year, that separate account generated about $85 just sitting there. And because they were making quarterly payments instead of monthly deductions, they always had a cushion of at least 1 month's worth of premiums available if something unexpected came up. Within 6 months, Jim and Susan told me they felt like they'd gotten a raise, even though their income hadn't changed at all. They'd just taken control of money that was already theirs. Now here's what you need to understand about how to actually implement this strategy. Because knowing about the MPPP and actually using it are two different things. When you first enroll in Medicare Part B, you're going to get paperwork from Social Security, and buried in that paperwork is the option to choose how you want to pay your premiums. Most people just check the box for automatic deduction because it seems easiest. And that's exactly what the system is banking on. Your willingness to take the path of least resistance. But you can choose to pay by getting billed directly from Medicare instead. You'll receive a bill quarterly, and you can pay it by check, money order, or through Medicare's online payment system. It's not complicated, it's not risky, it's just different from what most people do. If you're already enrolled and you've been doing automatic deductions, you can change to direct billing. You need to contact Social Security, and yes, I know that's about as fun as a root canal, but stay with me here and tell them you want to stop the automatic deduction and switch to direct billing for your Medicare Part B premiums. There will be some paperwork. There will be some verification, but it's absolutely doable. The key is that you've got to stay on top of those quarterly bills when they come. You cannot miss these payments, folks. If you don't pay your Medicare premium, they can terminate your coverage, and getting it back is a nightmare you don't want to deal with. So let me walk you through exactly what that $2,100 savings actually represents, because I want you to see the full picture. First, you've got the interest earnings on keeping that money in your own account instead of letting it disappear immediately depending on your interest rate and account structure. That could be anywhere from $50 to $150 a year. Second, you've got the value of improved cash flow management, which is harder to quantify, but absolutely real. When you're not living paycheck to paycheck, when you've got breathing room in your budget, you make better financial decisions, you're not paying overdraft fees, you're not using credit cards for emergencies, you're not paying late fees on other bills because you miscalculated your available cash. Those fees and poor decisions can easily cost you several hundred a year. Third, and this is big, you've got the opportunity cost of what you can do with better financial awareness and control. When you're actively managing your Medicare payments, you're also paying more attention to your healthcare spending overall. You start asking questions about whether you really need that test the doctor ordered. You start shopping around for better prescription prices. You start using preventive care more strategically. Studies show that people who actively manage their healthcare finances spend 15 to 20% less on unnecessary healthcare costs compared to people who just let everything happen automatically on an annual healthcare budget of $10,000 or $15,000 for a couple. That's real money we're talking about. And fourth, there's the appeal advantage I mentioned earlier. If you're able to successfully appeal an HRA surcharge because you're more aware of your Medicare billing due to managing it through MPPP, you could save anywhere from several hundred to several thousand depending on your income bracket. The higher income IMA brackets can add over $400 per month to your Part B premium. If you successfully get that reduced by proving a life-changing event, you're looking at massive savings. When you add all these factors together, direct interest earnings, avoided fees from better cash management, reduced healthcare spending from increased awareness, and potential IRMA savings, you can absolutely reach and even exceed that $2,100 annual savings figure. And listen, I'm not going to promise that every single person will save exactly $2,100 by using the MPPP. Your individual results will depend on your specific financial situation, your interest rates, your spending habits, and your overall Medicare costs. But I am telling you that the potential is absolutely there. And for most people who implement this strategy thoughtfully, the savings are real and significant. Here's the bottom line, and I need you to really hear this. You worked your entire life for your retirement money. You paid your taxes. You followed the rules. You deserve to keep every single dollar you possibly can. The Medicare Premium Payment Plan is not a loophole. It's not a scam. It's not some sketchy scheme. It's a legitimate option that the government provides, and it's designed to give you more control over your own finances. The reason most people don't use it is simply because they don't know about it. The system doesn't advertise it. Your Social Security representative probably won't mention it unless you specifically ask. And most financial advisors are focused on managing your investment portfolio, not optimizing your Medicare payment strategy. But now you know. Now you've got the information. And what you do with this information is going to determine whether you're the person who looks back 5 years from now and says, I wish I'd done that, or whether you're the person who says, best financial decision I made in retirement. The choice is yours. But I'm telling you right now, taking control of your Medicare premiums through the MPPP is one of those simple, practical strategies that can make a meaningful difference in your retirement quality of life. It's not flashy, it's not exciting, but it works. And in my world, things that work are worth paying attention.